All right, what's happening, guys? Welcome to another episode of Sensible Investing. My name is Jesse, and today we're going to be talking about the PE ratio, or the price to earnings ratio. So this is going to be a very simple guide for beginners in terms of the PE ratio, and why, although it's probably one of the most popular metrics people use to value companies and value stocks, why I'm going to tell you why it's actually not a very good indicator of a company's value.
Whoa, what?
Where it falls short, and what I believe you should use instead. So first of all, the price to earnings ratio 101. Okay, so what is the PE ratio? In short, the PE ratio is a way that people use to gauge a company's worth by looking at how much it earns on an annual basis, and then comparing that to the stock price. So what it does is it compares the price that you're paying to how many earnings per share, how many dollars or cents of earnings per share the company makes. So as you can see here, that's what it is, right? So the way that you calculate it is you divide the earnings, EPS, the earnings per share, by the actual share price. And the way that you calculate the EPS or earnings per share is you divide by the total number of shares on issue, its net profit after tax. So you can actually go and find that in the company's balance sheet. You look at the income statement and it will tell you net profit after tax. Then it'll also tell you the number of shares outstanding. You can find this on somewhere like Yahoo Finance, and then you basically divide the net profit after tax by the total number of shares. And so in theory, the lower the price to earnings ratio, the sooner you as the investors, quote unquote, get paid back on your investment, right? Because that's the whole purpose of investing, is to get more money than what you put in over time. Now, and then theoretically, the lower the PE ratio, the better, because it means the sooner you can get paid back and the less you're actually paying for the earnings that a company makes. And then in theory, the higher the PE ratio, the longer it takes, or the more of a premium you're paying for the company. However, what I wanted to do now is I wanted to take you through on the shortcomings of the PE ratio and why it falls short and what it fails to actually analyze or include. So I'm going to use an example, and I've made up a gold mining company called Gold Miners Are Us, right? And in short, the company, they operate two mines. One mine makes $10,000 per year of net profit after tax, and the other makes $25,000 for a total of $35,000 a year of net profit after tax, right? So now you might think, oh, great, this mining company, I get $35,000 a year, so if I put $350,000 into it, I'll make all my money back in 10 years, and then everything on top of that is, I guess, cream on top. However, this company bought Mine B for $400,000, and not only did they use that money to buy Mine B, they actually borrowed $300,000, right? So $300,000 of that acquisition was funded with debt. Now, it'll actually take them 8.5 years, based on their current earnings of $35,000 a year, to pay off all of the debt for Mine B, and that actually excludes any interest charges. So basically, that's only the principal amount. Now, I'd imagine they'll charge, 5-6% interest. So what they'll do is they'll be using their net profit to pay off the debt and the interest and any associated fees along with the acquisition. So what this means for the shareholders is basically any profits being used to pay down debt or any other obligations like interest as profits not being paid to you.
Where's the money, Lebowski? You want that money, Lebowski? Bunny says you're good for it. Where's the money, Lebowski?
So while in theory, you might think that they're making $35,000 a year, in reality, it's a lot less than that because their money is going to another commitment that is higher up the food chain or the importance ladder than you are. So basically, in short, the PE ratio does not take into account the money that the company owes as debt. It also does not take into account the people who are higher up the food chain than you, which get paid before you, i.e. people that own preferential stock. So for example, if the company goes under and it liquidates, all of the common shareholders get paid after the preferred creditors and people who own preferential stock. It also doesn't take into consideration that companies who spend a lot of capex, so capital expenditure to run their business. And the reason being is because not all businesses are equal. Some businesses take very little money to run and operate, i.e. very lean, mean businesses. And then some businesses take a lot of capex to continue operating, hence, companies like the automakers. So in order to keep their business going, they have to continually keep on pumping money into the business. And again, the reason why that's not good is because any money that's going elsewhere apart from you is basically money not getting paid to you. So what you want as shareholders is as much of that money going back to you as possible and as little of that money going elsewhere. And so that's the shortcomings of P ratio, is that it doesn't actually take into consideration any of these things. Now, before we go on to the next section, I just wanted to pause quickly here and show you a little extract of a video from Warren Buffett. And he himself probably says it better than anyone else, why it's so important to look at the actual amount of cash that a business can generate and give back to the shareholders, and why it's important to value a business based on that.
The only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference after as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question of how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground. You're laying out cash now to get more cash back later on. And the question is how much are you going to get? When are you going to get it? And how sure are you?
Okay, so as you can see, now that we've finished watching that video, I wanted to give you a comparison of two stocks and why I believe the EV over FCF, or the enterprise value over free cash flow ratio, is a much better measurement of a company's value or a company's worth than the price to earnings ratio. So we're going to compare Facebook with General Motors, a company that's a tech company that's asset light, low capex, no debt, very healthy balance sheet, versus a company that's very heavy in assets, very heavy in sustaining capital, lots and lots of debt. And we're going to look at exactly why the price to earnings ratio falls short and why the enterprise value to free cash flow ratio is so much better. So as you can see, I've pulled up their initial, statistics. And already you can see over here that the Facebook enterprise value is lower than the market cap. Now that's a good thing. And the reason being is because enterprise value includes all the debt and anything else that could affect you as the shareholders being paid, right? It might be minority interests, it might be preferred stock, it might be anything. So what you actually want is an enterprise value that's lower than the market cap, rather than with the case of General Motors, the enterprise value being higher than the market cap. Now, if you actually look at the trailing and forward PE, you might think, holy cow, General Motors is a shitload cheaper than Facebook. Like when I say a shitload cheaper, I mean a shitload cheaper. However, that's only looking at it from the very, very surface level. And if we actually dig a little bit deeper, we'll realize that whilst the PE ratio of Facebook is higher, General Motors doesn't actually have any free cash. So anything that they make, as you can see here, the levered free cash flow is actually negative. While Facebook is printing, sort of almost $11 billion per year in cash that they can use to either distribute back to the shareholders or whatever. And the beauty of the levered cash flow is that it actually includes any spend that they must make before they actually have the cash. So that's after they've paid off all of their liabilities. And so, as you can see, if we dig a little bit deeper, we'll realize why it's so important to look at free cash flow. As you can see over here, General Motors, they've got a net income per year of about $8 billion. But in order to make that $8 billion, they have to spend almost $25.5 billion. So what we're looking at here is basically for every $8 that they make, they have to spend 25 to make that $8, which is terrible value. So we as shareholders will actually never get paid.
Yeah, that's what happens, man. Oh my God! Yeah, that's what happens. Where's my money? You gonna give me my money? Where's my money, man? Where's the money?
Whereas with Facebook, you can see for every $22 that they make after everything, they only spend about $14 billion to make that. So that's much healthier. And as a result, as you can see, the debt of General Motors is just building up and building up and building up and building up. And somehow that debt has to be paid, right? Now, at the rate that they're going, they're probably not only going to be not able to pay off the debt, but they might even struggle paying off the interest on that debt with however much money they make. And as a result, if you think back to 2009, the government pretty much had to bail out the auto industry, which is exactly the reason why the price to earnings ratio falls short, is because it never takes into consideration all of their financial liabilities and commitments. So now what I'm going to do is I'm going to talk to you guys about why I like the enterprise value rather than the market cap, and then talk you through levered free cash flow. So what is the enterprise value? In short, the enterprise value looks at the cost of buying the whole company. And I'm not talking about the cost of buying every share, but what you're actually paying. So you're paying for the debts, you're paying for the minority interests, you're paying for the preferred shares. It basically looks at the actual cost of taking over an entire company. And that's what, very activist investors like Carl Icahn do. They look at the true cost associated with taking over a company and how much cash they can generate, which is why we should look at the levered free cash flow, not the actual earnings. And as you can see over here, the levered free cash flow is calculated as the net income, which already captures the interest expense, the changes in the net working capital, which is how much money a business needs to, in terms of the difference between their current assets and current liabilities, and whether they've got either more money coming in the door or more money out the door in terms of between their suppliers and people who owe them. And also, it does not take into consideration capital expenditures, right? So, for example, going back to the case of General Motors, yes, they might make $8 billion a year, but maybe they might need to buy a lot of expensive plants. They might need to, buy a lot of expensive equipment or whatever. And again, it does not take into consideration the debt payments. And all of these things affect yourself as the ordinary shareholder as to when you can actually get paid and whether if you can even get paid. So guys, I hope you enjoyed this short video and the explanation of the PE ratio and why I believe it's not actually a good way to value a company, and why the enterprise value to free cash flow ratio is a far better indication of a company's actual worth in terms of how much cash you can pay you as the shareholder back over time. So make sure to hit the like button and the subscribe button if you enjoyed the video. Leave a comment, and I'll catch you guys in the next video. And until then, happy investing.